This is an urgent, highly bullish analysis report focused on the immediate technical reversal of AMC stock, specifically that bounce from the 161 52-week low.
Right.
And what we love right away is that energetic declarative tone. It absolutely captures the urgency of a potential market shift. It works.
That energy is fantastic. It's exactly the right feel. The commitment to the call is, it's crystal clear. But, our job here is to make sure the analytical depth, the logic underneath it, is strong enough to support that high-octane delivery.
Absolutely. We need to build a foundation that can actually hold the weight of that energy. So let's dig right in with how the metrics are interacting with the story.
I agree. The analysis is clean, but some of the elements almost fight against the very pace that was so well established in the opening.
So the urgent declarative style of the report can be strengthened by weaving the immediate statistical data points more seamlessly into the narrative of the price action itself.
Right now, that section, the green flip, by the numbers, it lists out the key stats, the low, the high, the close at 169, that 0.6% gain.
And that separation is the weakness. The momentum just dies right when you need the proof.
Exactly.
You build all this incredible suspense about the 161 moment of truth, and then you basically ask the person to stop and read a static list of numbers.
It's like the narrator stopped a championship game mid-play to read the box score.
Yes, that's it. So the statistics aren't acting as confirmation. They're acting as an interruption. And the pacing it takes a huge hit.
Okay, so the friction point is clear. The numbers need to be active, not passive.
The report should really minimize that separation. Frame the metrics as the direct consequence of that market battle you just described.
So they reinforce the conclusion.
Immediately. The numbers should sound like the final, declarative punchline to the fight that was just laid out.
That's a powerful shift. But let me push back a little. If we start weaving in too many numbers, do we risk overwhelming the analysis? Losing that clean, declarative feel?
That's a fair challenge, and it all comes down to the language, right? We want to use the numbers to increase the urgency, not kill it.
Okay.
So for example, instead of just listing the close, you could describe how the stock finished the session at $1.69, a decisive gain of 0.60% that solidified the perfect bullish candle.
I like that. The phrasing itself carries the tone.
Yeah.
And we could do the same with the after hours push to 170. The analysis notes it, but it feels like a footnote.
Right.
What if we treat it as immediate evidence that the accumulation at 161 is already spilling over, that the fight didn't even stop at the bell?
Yes. And another concrete thing. Use the difference between the high and the low, that 11-cent swing.
Quantify the buying pressure.
Make the range part of the urgency. Emphasize the speed and the sheer force of that rejection off the low. The goal is just to turn those technical details from footnotes into narrative fuel.
Okay, narrative accelerants. I like that. That approach, done right, solves the pacing, and it really sets up the next point perfectly.
Which brings us right to, I think, the biggest logical gap in the analysis, connecting that minute-by-minute technical drama to the fundamental story.
Yes, this is where we move from structure to, true analytical rigor. The report does a great job stating the technical action and the fundamental case.
But separately.
Separately, it's missing that crucial wire that connects them, that explains why the two met at exactly $1.61.
To elevate the report from technical observation to robust analysis, the material needs to explicitly connect the identified fundamental catalysts to the specific technical event at that 161 support level.
So in Section 3, the catalyst, the case for long-term value is strong. It points to some great data. $1.3 billion in revenue, really strong concession spending.
$12.25 a person.
Right. And that really low 0.24 PS ratio, the price to sales ratio, that's a critical number showing just how cheap the stock is relative to its revenue.
That's the strength. The weakness is that it never explains how those fundamentals triggered that aggressive buying right at 161 midday.
There's a gap.
A big one. Why not at 180 or 170? Why was 161 the magic number where value investors supposedly stepped in?
It almost implies the fundamentals are just a nice backdrop instead of the actual cause of the defense. We need to bridge that macro value case with the micro price action.
And the suggestion here is critical. The analysis has to articulate a clear hypothesis that links that low PS ratio, that $867 million market cap, directly to that technical floor.
So the argument should be that the fundamentals provided the reason for smart money to put their limit orders right there.
Exactly.
But that forces a really tough question, doesn't it? Are the fundamentals causing the technical bounce, or is the bounce just going to draw attention back to the fundamentals?
And the analysis needs to commit to an answer. It implies the former, but doesn't show its work.
Okay, so concrete examples.
The analysis could hypothesize that the 0.24 PS ratio makes AMC fundamentally too cheap to ignore at that 52-week low. For an institutional buyer, 161 represents a point of maximum fundamental de-risking.
The technical line becomes the point of irresistible value.
Precisely.
You could also frame that strong concession spending as a leading indicator of, say, future earnings surprises, which makes the current price totally unjustifiable and encourages accumulation at the absolute lowest point possible.
It's about timing the market, not just valuing the company, right?
Mm-hmm.
You know the land is worth $1 million, but you pull the trigger when the price drops to $750. That's the moment the value thesis meets the technical trigger, merging the why, the fundamentals, with the when, that technical level. It transforms two separate good sections into one powerful, unified conclusion.
And that unified conclusion is what you need to tackle the inherent skepticism. Because the obvious question is, well, why did it fall that far in the first place?
Exactly. Which brings us to what I think is the most persuasive move you can make in an analysis like this, hitting the skeptics head on.
So, maximizing the persuasiveness of the bullish argument requires proactively confronting the implied negative context that comes with trading at a 52-week low.
I mean, it is inherently a vulnerable position. The analysis does a good job framing 161 as the concrete floor and the moment of truth.
But the weakness is that it focuses almost entirely on the danger of breaking that low. It doesn't fully leverage why a hold at a historic low is such an exceptional opportunity.
It's more of a survival story than an opportunity story.
Exactly. And it completely sidesteps the skepticism from anyone who is watching the stock's journey down to that 52-week low.
By acknowledging that preceding weakness, that steep drop, you make the current strength feel so much more potent. It's about turning that perceived vulnerability into the ultimate strength.
The suggestion then is to reframe that 161 event. It's not just survival, it was the final necessary washout that creates the best possible risk-to-reward scenario.
Yes.
The report already mentions the short interest is sitting around 11%. Use that number. Use it aggressively. Argue that this hold at the historic low now puts the bears in maximum jeopardy.
That shift is so crucial. By holding 161, the whole risk profile for those short positions, it fundamentally changes.
If the floor holds, their thesis is broken, right at the moment of their maximum theoretical profit. The reversal puts immediate intense pressure on them.
And the analysis shifts from just defending a price to actually predicting a short squeeze.
So to make that concrete, explicitly address that low market cap, the $867 million, not just as a tiny fraction of sales, but as the price that finally forced the last weak hands out.
The capitulation event.
It cleared the path for the reversal up toward that $2 psychological level.
You could also directly contrast that high short interest with the technical resilience at 161. Argue that holding firm under that kind of pressure proves the price is now unsustainable for shorts.
Right. It makes the next move feel more explosive.
And maybe the ultimate statement of conviction here suggests that the very fact the stock went from a near crash to closing up for the day,
up 0.6%.
at the 52-week low is definitive proof of aggressive conviction from buyers. And that should be the primary focus. The story shifts from "we survived" to "the bottom is in and the path is clear."
These shifts will really make sure that the urgency in the analysis is built on an unimpeachable foundation of logic. It boosts credibility massively.
It maintains the bullish intent while just dramatically increasing the depth.